question is, how does divestment or then using the money for something else change things? We won't make deep cuts in CO2 emissions unless we have laws that restrict the use of the atmosphere as a free waste dump and that therefore encourage low carbon energy to win. That in the end, that's got to be the goal. The question is this a useful path along the goal, to that goal?
Obviously, a price on carbon is what we need and a tax on carbon, but as in this case, as in all cases, the law is the lagging indicator. It's the late comer, as it was obviously profoundly in civil rights. The leading indicator, it seems to me, are industries like solar, which is just going like gangbusters. Ceres has actually put out an investment strategy around reinvestment, and I'm happy to share it. I mean, it obviously looks very carefully at investing in renewable energy in all forms. We don't want to get into a complicated analysis about return, and that's really more Jason's area anyway, but you're absolutely right. I mean, so what we actually encourage more than divestment is looking very, very carefully at the returns you can get from long-term investment. An encouraging report came out today I'm happy to share with the group. You may have seen from CDP, the Carbon Disclosure Project. It includes 50 companies that have voluntarily, on their own, established an internal carbon price within the company. Microsoft, perhaps the most famous, and I know the woman who single-handedly put this through, and it's a 101 on how to do it. So there's lots of exciting things at the forefront to really push this further, knowing that, of course, given Washington, it's going to take us a while to get a carbon tax, for sure.
So you actually raised something that I hadn't thought about very directly, which is, let's say that we've talked a bit about how if we divest from the fossil fuel companies, is anything really going to change in the fossil fuel companies? And the answer is probably no. Will it delegitimize the fossil fuel companies and embolden regulators to regulate it? Maybe, and that's part of the theory of change. But what you've raised, Graham, is this other piece of the puzzle, which is if we took the capital out of, now we don't know how much capital it is because we don't know the structure of the endowment. But if we took that capital that we do have in fossil fuel and very carbon-intensive fossil fuel, and we put it somewhere else, then we may actually that may actually be an avenue for a pretty significant impact. If it's investing in and actually providing capital to, commercialization of energy efficiency and renewable energy technologies, that could actually be a really nice thing to have happen. And maybe part of a progressive energy strategy, and I would encourage you guys as the fossil free to think about that. I just want to use this as an occasion to raise one other thing that's been kind of bugging me, which is that then the question that Anne raised is, well, okay, well, what would the return on investment look like from those renewable energy and efficiency investments compared to what you were getting from the fossil fuel, and does it make economic sense? And there's a economic argument that's being made around the edges of this fossil fuel divestment, which basically says, yes, that is the right thing to do because these are going to be stranded assets. The value of these companies is going to collapse. We should be in growth businesses. And so if you just wanted to manage the endowment from a financial standpoint and a fiduciary standpoint, that's exactly what you should do. I am very worried and skeptical and am going to be critical here of making an economic argument for divestment. And the reason is twofold. One is that I think it pollutes the moral argument. We have, there's a study, an experimental psychology study that we're working on right now at Sloan, the early results of which suggest that if you make a combined business self-interest argument and moral argument for a program or initiative, it undermines both. It makes people believe that there's actually less of both when you make the combined argument. Because we're not exactly sure what the mechanism of it, but something like, if you're having to give me two arguments, neither of them must be very good. And so if you just make the moral argument or you just make the economic argument, you might end up in a better term. So there's something to be said for clarity of argumentation around this. And the second piece is that I think the economic argument for the endowment and its fiduciary, return on investment and fiduciary responsibility, I think is fairly weak because it requires two pieces. One is, will these stocks actually lose their value? And two, will they lose their value before we're able to sell them off? And those are the two things that would have to happen if we were to actually lose money from fossil fuel companies. And the first one is predicated on there being a significant enough legislative action that actually the assets do become stranded. And None of us see that on the near-term horizon, although hopefully the divestment campaign results in that fact. But the second is much more important, which is, can we just sell the assets before the rest of the market sells the assets? And I think that's very likely. MIT's endowment is in smart money, right? And smart money will move the game, I think, and not respond to the game. And so the chance that we'll lose money on this, I don't see it as being particularly likely. Now, we did make some bad bets in the .com bubble when it burst. The endowment lost a lot of money, but that was predominantly because we were getting donations from alumni in the form of stock in their tech companies. And so the sell-off wasn't likely or imminent. So I think that I would avoid the economic argument in this case, except to say, there may be some issues here, and if divestment is successful at other places, that may end up hurting these stock prices. So maybe you should be considering environmental, social, and governance, or ESG risk in your portfolio. And that's a perfectly legitimate thing to ask the endowment to do. But I think that is a completely different channel. It's a completely different approach. It's not a moral activism approach. We're here to help with the financial analytics to help you do that. It's much more of a Sloan School group of finance students there to help as consultants approach than it is a 2,000 petitions approach. So I think it's important to keep those things somewhat distinct.
I guess the first is, I'll try to address a few of the things that have been said. A recent report came out from Oxford University Smith School for Enterprise and the Environment, and it was basically a critical account of this divestment campaign in comparison to previous ones. And they found that in almost every case, divestment has led to restrictive legislation in one way or another, from the Sudan Accountability and Divestment Act to the Comprehensive Anti-Apartheid Act to stigmatization that leads to the price of a pack of cigarettes going from $1.75 in 1980 to $4.25 today. Divestment can work through its indirect effects. And MIT, by the way, knows that it can work, because remember that MIT has divested before from the genocide of Darfur. That's my first point. The second, I guess, is coming back to your question about kind of what happens with the money, how is it useful, and sort of what avenues can it be put into. I guess the first, I'd like to do a few kind of little experiments. So the first is sort of the money that is currently invested in fossil fuels versus money that we could be spending on sustainability on campus. So like Dr. J said, we don't know how much of our endowment is invested in fossil fuels because it's secret. But we can look at other case studies. So for example, University of Michigan, they have an endowment that is 38% lower than that of MIT's. But they have invested $1 billion in the fossil fuel industry. We know that because the students used their Freedom of Information Act rights to obtain that information. So for the sake of argument, let's assume that MIT has $1 billion invested in the fossil fuel industry. If you take that $1 billion and divide it by the $674 billion that the fossil fuel industry spent last year developing carbon reserves, you can calculate, this is very back of the envelope, this is a physicist talking, right? But you can calculate roughly MIT's contribution to carbon extraction. It comes out to about 10 megatons. So what's MIT's on-campus carbon footprint? It's about 0.2 megatons. So my point really, thank you, yeah. Yeah, so just to back up, MIT has a carbon footprint of 0.2 megatons, and it's funding the extraction of about 10 megatons. So the point is that by divesting, we can have an effective greening of the campus effect, an order of magnitude or two greater than the most comprehensive sustainability efforts. We would have to shut down the university many times over in order to have the effect that divestment could have. So that's divestment versus sustainability. My next thought is divestment versus renewables, investing in renewables research, for example. Last year, the US government spent $1.8 billion investing nationwide in renewables research. And remember, we're assuming that maybe we have $1 billion in fossil fuels. So if we were to take that money and reinvest it in renewables, we would be increasing governmental nationwide renewables research by more than 50%. And in my mind, that's a pretty good investment. The final aspect is regarding financial impacts on our endowment. We have this fiduciary responsibility to maintain the longevity of our endowment. And I guess I shouldn't really be going into the economic arguments, but I'm going to try. I'm not going to talk about the carbon bubble, because I think we've touched on that already. Rather, I'll think about the short-term impacts, the returns. And, you know, I'm not an economist, and it was Truman, right, who said, give me a one-handed economist, because mine keeps saying on the one hand this, on the one hand that. But I know of a couple, all the studies I've seen make me pretty optimistic. There's an index study group called S&P Capital IQ. They did an experiment where they took $1 billion, a hypothetical endowment, and 10 years ago, hypothetically, they invested it in the S&P 500 index. It's a standard trading index. And they did it in two ways. They either screened it for fossil fuels, the same fossil fuel companies we're asking to screen, or they didn't. The one that was screened went from 1 billion up to 2.26. That's the divestment one. The control went from 1 billion to 2.14. So the divested endowment yielded $119 million surplus compared to the control. Likewise, there's an investment management firm called Aperio. They did a similar study where they looked at the effect of screening on financial returns. They found that the tracking index, which is so cool, I don't know what it means, they found that the tracking index for fossil fuel screening was about 0.6%. But what I do know is that that translates into an incremental error of 0.01%. And that's on the back of an 18 to 20% standard deviation in the stock exchange. So what they concluded is, okay, you add 0.01% error to a 20% variation. So at least from a physicist perspective, that sounds all right to me.